Hey everybody, Brian Shannon here from alphatrends.net. It's Friday the 28th of August 2015 and it's been an exhausting week of a lot of volatility in the market. Interestingly enough, the S&P 500 was up 0.81%, NASDAQ up close to 3%, the semis up 6%, and oil was really the big winner, but obviously these closing numbers don't tell the full story. So let's go ahead and take a look at the charts and see where we are because we're still down 3% for the year in the S&P 500. We've seen obviously major damage done here. The point is nobody knows if this market's going back to where it came from or if we're going to see continued volatility ahead. I believe that we're going to see continued volatility. We broke this first important level of support a week ago, and then on Monday, of course, we had that gap lower. Now we're back into this prior band of support in here. And that was, of course, after coming very close to testing the fourth quarter lows of 2014. So there's a lot of opportunity in this market for short-term traders, but it's not easy by any stretch of the imagination. We did get a nice move after the trend line broke here on Wednesday, and then it actually, at this point, it had taken out what was the 3-day volume weighted average price, or the week to date since that gap lower. That right there is that volume weighted average price. And you can see where it really took off there and then gapped up above the declining 5-day moving average on Thursday. We pulled back, tested that area. Now next week we want to see 195 to 196 hold as support. If we see 195 to 196 hold as support, then we can do some further consolidations of these losses. That is a little further stabilization rather. But breaking back below 194.5, let's say, and staying there below that for a half hour or so, then we could be headed for a retest of these lows. It seems pretty unlikely to me, as that was very panicky action and showing that there were issues with the market overall beyond just pricing, but with the way that the market operates as well. Anyways, back to the S&P 500. Let's look at it objectively here. We have a 5-day moving average that's flattening out. The ideal scenario in my mind would be to pull back down towards this level and maybe just a little bit below this low here, so a little shakeout and then kind of recover a little bit next week. But it's going to be very volatile, and this patient is pretty sick in here, so we're going to have to take it with a lot of care day by day. If you made purchases into that panic sell-off, even there it wasn't very easy. As after Monday we gapped up on Tuesday and closed at new lows on a closing basis on Tuesday afternoon. So just tremendous volatility, which equates opportunity, but that cuts both ways, obviously. Let's take a look at oil real quick here. Oil had the big week, and that was basically in the last 2 days mainly. That here's where we finished off 2014. So year to date, we're still well below the lows, but we obviously saw a huge rally there from about 38 bucks a barrel to $45 a barrel. So big percentage move there. It's still structurally broken, and I would think that if we get a little bit further strength, it's likely to kind of take a pattern that looks maybe something like this. And then perhaps comes back up a little bit. But we'll see what the market gives us. Our job is not to predict, but to anticipate different scenarios. And with this S&P again, we've got it below a declining 10, 20, 50, 100, 150, and 200-day moving average at this time. So it remains highly suspect in spite of the fact that it was up this week. The NASDAQ as well, this market showed some relative strength, and it is back into this prior band of support in here. So let's see if this market can hold in this general area and perhaps add a little bit further. Looking at a 10-minute chart with that 5-day moving average, you can see that, can he really even count this? I mean, I guess, if you sold in there or bought in there, you absolutely count it. But that was just such a quick aberrant move, really, that it just is tough to really look at and take as a serious level for this market. But the fact is, prices did exchange hands down there. There was opportunity if you were able to get involved in it. It was a fantastic opportunity. This market held up much better than the S&P 500, as we found that Monday's afternoon lows did hold on Tuesday, and we got that similar trend line break in here that led to this rally. Now I think that next week we want to see basically 102 to 103 hold as support. If that holds as support, then we maybe settle down in here a little bit and show some stability. But it's difficult to believe that after this big of a move this week that we're not going to see continued volatility. There just seems to be money, sloshing around everywhere with a lot of uncertainty throughout the global markets. The Russell 2000 is still, in weaker shape overall. We're down 3.3% this month, down close to 6%, in spite of the fact that we were up a half of a percentage point this week. And the pattern is still a much clearer one in here of lower highs and lower lows. This is still, even if we get up to here, we're still, this is what we would consider a lower high. So it's a bounce within a downtrend until proven otherwise. Only price pays, but you notice that it sold off on successively heavier volume, and it's rallying on lighter volume relative. That's just a level, something to take note of. It's definitely not anything that pays, only price pays. But here we have our previous lines of support and resistance that are really just kind of irrelevant now. They're so far away. So looking at this, I think that the bigger level of resistance, if we continue to bounce, would be likely found up here near 118 to 119. And if we begin to pull back a little bit and to rebuild a little bit of stabilization in here, I think that it's looking at about 112.5 to 113 is our band of support that we want to see hold early on next week. That would also have us holding the 5-day moving average, but it wouldn't make it a buy unless you are, of course, a short-term trader. And the semiconductors, they broke their downtrend line a little bit later than the rest of the market. In other words, they were lagging, whereas the other markets kind of broke those on Wednesday afternoon. It wasn't until Thursday that the semiconductors broke that downtrend line and got going with that gap higher. Now we want to see that ideally, I think 48 to 48.5, if that holds as support. These are levels that I update every single day for subscribers. If you're interested in end-of-day analysis of these markets and key levels, it's only, I think it's $149 a year. I'm not even sure for the Browns level. That's going up soon, by the way. It's just the demand has been there for it, so that price is going to be going up. So if you want to lock it in for I think it's 149, whatever it is on the website, but this is the potential bigger level of resistance for the semiconductors. We've traveled pretty far pretty quickly, so some pullback consolidation would not come as a surprise. The biotechs, as we know, they broke that key support 1 week ago today, and obviously, like the rest of the market, they got smashed. Now it's going to be important to see how it handles if it can rally up towards 360 or so. You don't want to be shorting these markets on these rallies until they start to roll back over. Right now, we're looking at these markets and saying, let's see if they can hold key levels of support on a pullback. And if you're going to be a day trader and short weakness, with these levels as your targets, then that's fine. But you always have to be aware of the risk and where does it have the potential to go as well. We've got 360 as potential overhead supply. We don't know if it's resistance until it goes up there and gets rejected. Then we can say it was resistance. Until then, it's just a potential level of resistance. Let's take a look at the shares of Apple, which Apple did gain some ground this week. It's still in a downtrend. There's nothing changed there as far as a declining 10, 20, 50, 100, 150, and 200-day moving average. So these markets are, and here's the thing to remember about Apple as well. Since the last earnings report came out and the stock gap down, we've got this trend line just in this area. We've got this prior little band of support as well. And if we take a look at the volume weighted average price since that earnings report right here, you can see me drawing it across. It's right there at about 115. So if you're trading intraday, there's opportunity obviously in Apple, but be aware of this 114 to 115 level as a potential level of resistance. It's pretty close to where we are right now. So to me, it looks like buying this stock in this area, the risk reward is definitely no longer existent for the bounce trade. So that'll do it for me for today. I'm not going to talk about a lot of individual stocks. They pretty much all look the same. So tune in next week, and I will maybe have a midday video next week I'd post to the site. So hope you avoided some carnage this week and didn't make any emotional decisions. Thanks for tuning in. I'll talk to you again next week.